Self-employment tax is the line that catches every newly self-employed coach off guard, because as a W-2 employee, they never saw it as a separate number, 15.3%, on a separate track from income tax. It applies to every dollar of self-employment earnings up to the Social Security wage base, and the Medicare portion keeps going without a cap. The S-corp election exists primarily as a mechanism to reduce this single tax line by labeling some of your earnings as distribution rather than salary. This video walks the composition, what it applies to, the deduction that takes some of the sting out, and the savings math that drives the S-corp decision. C tax runs on a separate track from income tax, and most first-year coaches don't realize they're owed both. Income tax follows the federal brackets you already know, 10, 12, 22, 24, and so on. SE tax is on top of that, computed separately on a different line paid on the same return. It's the self-employed version of FICA, the payroll tax stack that W-2 employees split with their employer half and half. As a self-employed coach, you're both the employee and the employer for tax purposes. You pay both halves combined, 15.3% of net SE earnings, with the composition and the cap rules covered in the next slides. The composition is 12.4% Social Security plus 2.9% Medicare, with one additional surtax above $200,000. Social Security caps at the SS wage base, which is about $168,600 for 2024 and gets refreshed annually by the SSA. Once your SE earnings cross the wage base, the 12.4 portion stops adding. Medicare has no cap. Every dollar of SE earnings owes 2.9% of Medicare for the life of the year. Additional Medicare surtax is 0.9% on the portion of combined income above $200,000 for a single filer, with different thresholds for other filing statuses. Most coaches operate in the band below the wage base. What SE tax applies to is the whole defensibility case for the S-corp election. Sole prop or single member LLC, SE tax applies to 100% of Schedule C net profit, after a small adjustment called the net earnings from self-employment factor of about 92.35%. S-corp owner, SE tax applies to 100% of W-2 wages drawn from the corporation. S-corp distribution, SE tax applies to 0. That last line is the entire mechanism of the S-corp savings. Every dollar of profit you can label distribution instead of salary escapes the 12.4 SS portion of SE tax. That gap is what makes the election pencil at the right income levels. The SE tax deduction takes some of the sting out by reducing income tax base. It does not reduce SE tax itself. Half of your total SE tax, the employer equivalent portion, since you're paying both halves and the employer half is treated as a business expense for income tax purposes, gets deducted from AGI on the 1040. That deduction reduces what you owe in income tax, not what you owe in SE tax. The SE bill itself is still computed on the full 15.3. After the deduction works through the income tax brackets, the effective combined rate sits around 13 to 14% for most coaches. The gross obligation that gets computed on Schedule SE is still 15.3. The S-corp savings math worked through with illustrative numbers, not Tandem's numbers, per the boundary in Module 0.1. Net S-corp income $100,000. Reasonable salary $60,000, distribution $40,000, SE tax on the salary $60,000 times 15.3%, $9,180. SE tax on the distribution, 0. Sole prop equivalent for comparison, 100,000 times the 92.35 adjustment times 15.3%, about 14,130. Gross savings, about 4,950 in unpaid SS on the distribution, minus roughly 2,000 in S-corp operational costs. Net annual savings, about 2,950. Once your S-corp W-2 salary crosses the SS wage base, additional savings from larger distributions diminish on the 12.4 portion. The math changes shape at that crossover. Below the wage base, every additional dollar of salary you don't pay yourself saves the full 12.4%. Above the wage base, the salary has already crossed the SS cap line, so additional distribution dollars don't add to the SS savings. Social Security is already paid up to the cap. Medicare savings continue because Medicare has no cap. The 2.9 Medicare portion keeps adding for every dollar of distribution. The headline benefit, though, is the SS savings on salary below the wage base, and that's where most coaches operate. Sole prop versus S-corp at 120,000 of net income, year 3 of the practice. Sole prop scenario, 120,000 net times 92.35 times 15.3% equals about 16,956 in SE tax, half deductible from AGI on the income tax side. S-corp scenario year 3, 75,000 salary plus 45,000 distribution. SE tax on the salary, 11,475. SE tax on distribution, 0. Gross savings, 5,481. After 1,200 CPA increase and 780 payroll service, about 3,500 net annual savings. Before you leave this video, run your own numbers through the calculator so the dollar case is on the page in your own terms. Open the SE tax plus S-corp savings calculator. Sole prop tab. Enter your projected net SE income for the current year. S-corp tab. Enter the reasonable salary number you researched in Unit 11.2.1. The output is the gross SS savings, the net savings after typical S-corp costs, and the comparison side by side. The net savings number is the dollar case for the election. Bring it to your CPA along with the Don't Elect Yet decision tree from Unit 11.3 and run the after-state tax comparison together. That's the conversation that decides the election.